Hello everybody, Ignatius CPA here with a quick update for you regarding a couple tax bills that are working their way through Congress. One has actually passed and was signed into law by President Biden. The other one is still working its way through Congress, passed the House, and is in the process of going through the Senate. And hopefully it dies in the Senate and we don't have to hear anything more about that. So the two bills are the Infrastructure Investment and Jobs Act is the first one. That is the one that actually passed and was signed into law. And so that one's official. That one's definitely law and something that you want to think about and consider. Okay. But there's not much tax provisions inside that bill. A lot of it's just a bunch of spending that they wanted to do on infrastructure within the United States. And so definitely got pared down from the original components of that infrastructure bill, where majority of that spending was definitely not infrastructure related, but there's still some fluff in there for sure. So we're going to talk about that one, and then we're going to talk about the Biden tax plan, or as they call it, the Buildback Better plan, which to me is a walking contradiction because that thing doesn't do much of any of that. And so nevertheless, you want to go ahead and stick around. We're going to get into all that. Thanks for joining my YouTube channel. This is a video. I'm Ignatius CPA, obviously, and I want to definitely update you guys on these two things. So stick around. We're going to be right back in a second. All right, everybody, and we're back. All right, so again, today we're talking about two bills: Infrastructure Investment and Jobs Act. Okay, and then we're talking about the Buildback Better Act, which I also call the Biden tax plan because I really don't like the name of that bill. It doesn't really do what it says it's going to do. And so we're going to run through these real quick and explain the tax implications of each one of these, and you can do with it what you will from there. But obviously, if you have any questions or concerns or thoughts, go ahead and reach back out to us with any of that, and we'll do what we can to give you that info. Okay, so let's talk first about the one that actually passed and was signed into law, the Infrastructure Investment and Jobs Act. So there's really only two provisions in there that are relevant related to taxes. The employee retention credit. So you've heard me talk about that before. It's pretty lucrative. Still recommend if you think you might qualify for the employee retention credit, reach out to us, talk to us about it. We can help you figure out if you actually qualify or not. And you generally had to have a reduction in your revenues between 2019 and 2021 or 2020, and then you also had to, or you had to have been shut down by some governmental order. Okay, and so if you do qualify for that employee retention credit, definitely reach out to us. But the last quarter that you're eligible to receive the credit for is now September 30th of 2021. So previously I told you back with the American Rescue Plan Act, I believe it was, there's been so many I've kind of lost track. They signed into law the extension of the employee retention credit to Q3 and Q4 of 2021. Well, now they've basically said, oh, well, we probably shouldn't have did that. So they're backpedaling like they've done on so many other topics in this administration and within Congress, and they deleted the Q4 provision for the employee retention tax credit, and so that is no more. You cannot do that one for Q4 of 2021, but you can from Q2 of 2020 all the way up through Q3 of 2021 if you qualify based on the various metrics. And I'm not going to get into those details on this. I have another podcast, but I do have a podcast as well, by the way, if you aren't aware of that, called the CPA Huddle. But and there's an episode on this as well. But my YouTube video, there's also another YouTube video on how to qualify for the employee retention tax credit. And so I highly recommend you go and listen to that video if you think you might be able to get some additional dollars. It's very lucrative, so highly recommend that. Okay. That's basically it on the employee retention credit. Crypto asset reporting, okay? That's another thing that has changed. Now this one, I will say there's a delayed effective date of this. to, I believe 2023 is the year that it's currently planned to be effective. And so you have a little bit of time to figure out if this is going to be something that will impact you or not. But what that means is it also can change. So we have the midterm elections coming up, in which case Congress could change significantly, and a lot of people are forecasting that it will. And if that happens, you may see some changes to this crypto asset reporting aspect, because there's a lot of people who didn't really like the way that it was worded. Okay? But essentially what this means is if you invested in cryptocurrency in a taxable account, you might want to start to make sure you're reporting all this information, because a lot of the brokerages are going to have to start reporting this to the IRS, which means if you've been not reporting it, which is illegal by the way, but hopefully none of my clients have been doing that, then you definitely want to make sure you get ready to start reporting it, because there's going to be a lot more information being provided to the IRS going forward. So that's the crypto asset reporting change. The latest digital, they call it digital assets, so it could be anything, NFTs, Bitcoin, Ethereum, any of those digital currencies are going to qualify, and so you have to kind of be a little concerned about that. If you haven't historically been doing it and you have some sizable gains, get ready to pay some more taxes on that activity. Okay, now I've talked about that one before as well. We all know a way to get around that. Put that sucker into your retirement accounts, preferably a Roth IRA or a health savings account, because those are tax-free growth vehicles that you can pull out tax-free. So that's a way to get around having to worry about these changes to the crypto asset reporting, because it wouldn't matter, because you're inside of a tax-deferred or a tax-free account. Okay? Bam. That's the Investment, Infrastructure, and Jobs Act, or Infrastructure Investment and Jobs Act tax provisions. The rest of that bill is not really important, so we're not going to talk about it. Okay? Let's talk about the Buildback Better Act, because that's a lot more important. All right, because this one has significant ramifications if it does actually go into law in effect based off of its current state. Okay? So, first thing we'll touch on is a 1-year extension of the expanded child tax credit, permanent extension of fundability of that credit. Okay, so what this means is for taxpayers whose AGI, adjusted gross income, that exceeds $150,000, that is below $150,000 for joint filers, $112,500 for head of household, and $75,000 for other taxpayers, meaning single or married filing separate. Okay, for those types of taxpayers, you're eligible for the expanded child tax credit, which is $3,600 for if you have kids under 6 years old per child that's under 6 years old, and $3,000 for children that are over 6 years old. Okay, so you'd be eligible for that higher child tax credit. If your AGI exceeds those amounts, then you're only eligible for the $2,000 child tax credit up until you make income of about $400,000, in which case it phases out completely and you're no longer eligible for the child tax credit. Okay, so they did go ahead and sign that, or not sign that, but pass that in the House, and so that is a potential possibility if it makes its way through any sort of final bill that gets passed by the Senate and signed into law by the President. Okay. They extended also the earned income tax credit provisions, which basically allows more people to qualify. Okay. And it also increased the phase out limits in regards to qualifying for that credit, basically. So those got expanded as well. See, now these two provisions, the child tax credit and earned income credit, are a sore subject for me, because as a tax professional, I see so many people that abuse these credits. It's ridiculous. And I've literally had conversations where people are like, how much do I have to make in order to get the earned income credit? And that's all that they do. And those are not my clients, by the way. I don't even entertain those people, because I am categorically opposed to people abusing the system and, working just enough to get these credits. And then we basically are paying for people to sit at home on their butts and do nothing, not be productive members of society. So I'm just not a fan of these two credits generally speaking, at all. The way that they're structured, anyways. I believe there should have to be more qualifications to get these. And if, for example, you leave your job, all right, and you weren't fired for, just like laid off or something like that, then you should not be eligible to get the earned income credit, as far as I'm concerned, because frankly, you probably were just gaming the system. Went to work for a couple months during the year, and then you decide, oh, well, I don't want to work the rest of the year, so I'm just going to utilize the money from the government. So anyways, I won't get too much more into my soapbox, but these two things I just absolutely am categorically against, period, especially the expansion of them. It's just craziness to me. So we've already given people enough money, enough free money, I should say, these last couple years here with all the various bills. And this is both sides of the aisle, people. I'm not condemning the Democrats for what they're currently trying to do any more than I would condemn the Republicans for what they did back when this pandemic first started. Like, I think it was all a lot of too much money, that we've spent over the last couple of years, and it's just ridiculous as a country that we're doing this and that we're trying to continue to do this. So, anywho, let's see, other changes that happened in the Buildback Better Act, or I'm going to stop calling it that. I'm just going to call it the Biden tax plan. So the Biden tax plan also would increase, and this one's pretty interesting and funny. It's going to increase the SALT deduction. SALT means state and local income tax deduction. So as you know, if you itemize on your taxes, you receive a deduction for your state and local taxes, okay? And so this is going to increase that cap from $10,000, which is where it currently is at, to $80,000. So an additional $70,000 worth of deductions. Now, let's think about this, people. Who primarily is paying the highest amounts of SALT taxes? Let's think about this. The rich people. And yet, they keep saying that they want to tax the rich more, and there's a lot of provisions in here that are taxing the rich more, but they're also at the same time giving them this deduction, which a lot of the rich people that are living in New York and California and some of these other places are going to benefit the most from this. Frankly, this primarily benefits high-income taxpayers because the biggest component of this typically is going to be the state taxes. Property taxes are also included in this, so real estate taxes, for counties and stuff like that you're paying. So, there's a little component of that, but the majority of this I feel like is going to come from state taxes and those deductions, which means you're basically giving the rich a tax break by putting the SALT deduction cap in here and increasing it. So find that kind of interesting, to say the least. All right. So again, additional changes. We've got the premium tax credit, which is related to getting health insurance through the marketplace. There's some extensions of some of that and expansion of some of that to allow people to be eligible. So if you're someone who gets health insurance through the marketplace and you're a lower income person, definitely reach out to someone to discuss that one more. I'm not going to go into the specifics of that because that gets a little tricky in terms of what you qualify for or not. But I will say that it's open enrollment right now on the health insurance marketplace. So since it's open enrollment, the best thing you could do is just go out there, put in all your numbers, put in your income, and it will tell you what you're eligible for. And if this goes through, then you might get an increased credit potentially. Or if you didn't get a credit, you might get one going into next year if this bill goes into place the way that it currently is. Okay? So I don't think this one's a big factor for too many people, so I'm not going to go into more specifics on that. All right. 15% minimum tax on profits of large corporations. This one, again, is not going to impact most of my clients or most small businesses, period, because it doesn't even go into effect until you report over $1 billion in profits to shareholders in your corporation. So we're really talking about these big multinational public companies for the most part. There are certainly some private companies that are this large, but for the most part, this is going to be publicly traded companies, and so those are not my clients, and so I'm not going to go into it very much. But basically just know, if you have a corporation that has over $1 billion in profits, then there is a new 15% minimum tax that they're trying to put into place to where you're not going to be able to take a bunch of credits and deductions and stuff like that and avoid paying no taxes at all. So this is primarily going after your tech companies, your Amazons of the world, et cetera, who, the politicians don't like, right? Because they make too much money and they don't think they're paying their fair share. Anywho, there's also a 1% surcharge on corporate stock buybacks. And again, this one primarily is going to be related to large publicly traded companies. So I'm not going to go into any more specifics on that. But if you have a corporation or you work for one and you're in their accounting department, something you might want to look into and think about how that's going to impact you guys. Okay. There's also some additional information on limitation of interest expense deduction. And again, this one is not going to really impact most of my clients because you have to be making pretty sizable profits, pretty sizable revenues in order to even have to worry about this. And so majority of my clients are not going to be impacted by this because I primarily work with some of the more mid-tier small businesses that are out there. And so not something that you would necessarily need to worry about. But basically it relates to international financial reporting and some other changes to that kind of a situation that will limit your potential interest expense deduction in your taxes. Okay. Let's see. What else? Okay, this one's a big one. The small business, stock, and high income taxpayers. Okay. So what this is going to do is for tech startups, especially, this is very common, where you get where you can sell basically your founder shares or your stock that you get in the corporation for working your butt off to grow this business and make it a viable business. Okay, so there's a law that allows you to exclude either 75% or 100% of the gain from the sale of that stock, up to $10 million worth of gain, basically. And what they're basically going to do is only allow that for people who make less than $400,000 a year. Okay, and so they're going to basically start disallowing that exemption to occur if you make more than $400,000 a year. So pretty easy to get around this one. Actually, it just means that your corporation shouldn't pay you any more than $400,000 a year. I would think this one's pretty easy to to probably get around, but you never know. You could get into a situation, especially for some larger startups, that sell maybe in an IPO versus being bought pre-IPO and kind of having some type of a private sale. This might affect those people a little bit more, but yeah, definitely some people that might be impacted by that one. So something to think about and consider. Watchtower rules. Okay, this is a potentially big one depending on how you utilize your cryptocurrency. So this one, if you have cryptocurrency, foreign currencies, or other, they would be subject to Watchtower rules if the Biden tax plan passes and gets signed into law. It does, eliminate the ability to do those a wash sale without having to factor in that wash sale, which basically means you sold the stock or the cryptocurrency or whatever, and then rebought it within 30 days. Okay, that's what the wash sale rule says. If that happens, then you can't take that loss, and you have to basically defer the loss until you go and you sell the stock at a future date. Okay, and so from that standpoint, there's some people say there's been abuse on this. I don't think there's really abuse. It is what it is, but I'm not really one way or the other too much against this one. But yeah, anywho. Net investment income tax, okay? The bill would amend a portion of the tax code that basically now subjects income from S corporations, partnerships, and Schedule C business income to the net investment income tax, which is 3.8%. Okay, so if your taxable income is over $400,000 single, $500,000 married filing joint, or $250,000 married filing separate, then you would now be hit by this additional 3.8% net investment income tax on any business income from an S corporation, partnership, or sole proprietorship, basically a Schedule C, okay, or Schedule F for farmers. So this one stings a little bit. You know, this is a pretty big hit, but at least they left the QBI deduction alone. So I will give them that. They did not go forward with trying to eliminate the QBI deduction for high income earners, which is a qualified business income deduction of 20%, okay, for your business activities. So at least they left that alone. So it's kind of a win, but I still don't think this should pass at all either way, okay? And then the last, things that are in here relates to, okay, so the last thing I'll talk about before I get to retirement stuff is the electric vehicle tax credits, okay? So for these electric vehicle tax credits, there's some additional credits that are going to be available. If you have any interest in buying an electric vehicle, I would say reach out to someone to think about if this might apply to you or not. For the time being, though, obviously this bill hasn't passed, so nothing to probably plan for by the end of the year. But going into 2022, maybe keep an eye on that and see if it might help you in terms of buying an electric vehicle starting in 2022 potentially. Okay, retirement plans. All right, so this one's an important part of the topic that we want to get to. Retirement plans are very important and near and dear to my heart, obviously. So the majority of the crap that they were trying to do has gone away. But if you notice from the last video that I did, I said everything went away. That was true for about 1 week, and then they put all the crap back in. Okay? I shouldn't say all the crap, but a little bit of the crap back in. All right? So there's still a few provisions related to retirement accounts that remain. All right? And they suck. I'm just going to be perfectly honest with you. The bill would also prohibit future Roth IRA, backdoor Roth IRA contributions. Okay? So nobody can do a backdoor Roth IRA contribution regardless of income, which really just sucks royally. And I hope they change this because that is a very, very powerful tax planning and wealth building strategy for a lot of middle income people. A lot of people in that $200,000 to $600,000, $800,000 range. That's a pretty powerful wealth building and tax planning strategy for them, and it really sucks that they're trying to take that away. So nobody will be able to do it. Not even, again, people who just make $250,000 a year, which is not a whole lot of money, people, especially with inflation and everything. I get that there's a lot of people out there that barely make $50,000 a year. I trust me, I understand that, but we are penalizing more than just the rich in this scenario. And so this one I hope doesn't stand through the final passage of this bill, but for time being, it's in there. Okay. And so additionally, it's going to put a cap on how much you can accumulate in Roth IRAs, traditional IRAs, 401ks, 457Bs, and any other defined contribution plan, okay, to a cap of $10 million. Now, the nice thing about this is it does not include pension plans or defined benefit plans is the official term of those. It does not include those types of plans, okay? So you can have the $10 million in your IRAs and your 401k and then still have a pension plan as well. But the max you can put is now $10 million if this thing goes through in its current state. No changes, $10 million. That's the most you can have. Okay? This would apply for anyone who has income over $400,000, single or married filing separately, 425 head of household, or 450 married filing jointly. Okay? So if you're below those thresholds, you can actually still accumulate assets above the $10 million mark. So that was one positive change that I actually did like that they put in there, because I think they were taking a lot of heat, and because this is primarily, let's remember people, this is primarily against Peter Thiel and his $5 billion Roth IRA. Okay, that's the funny thing about this. And what's really interesting is they're going to require people who are over that income threshold and do have more than $10 million to take a minimum distribution. Okay. But what's funny is, if it's a Roth IRA, there's no penalty or taxes for taking it before 59 and a half. So they're basically just giving people, free money anyways, and forcing them to take it out before retirement age without any penalties or interest, or taxes, excuse me, not interest. And so again, this thing is just silly, it's stupid, and it's definitely just something that they're going after this one person, and it's in overreach, to say the least. Okay. In all these, so the provision regarding the $10 million and the cap and the distributions and everything like that would be effective beginning for tax periods beginning after December 31st of 2028. Okay, so you actually have a little bit of time on that one. And the backdoor Roth IRA, just to be clear, that is effective as of the end of this year if it goes through. Okay, it's going to be eliminated as of the end of this year if it goes through in its current state. All right. And then the last thing that remained in, all right, are Roth conversions. So backdoor Roth IRA, let me clarify the difference between these two. A backdoor Roth IRA is when you make a non-deductible contribution to either a 401k or an IRA, okay, and then you convert that non-deductible contribution to a Roth, okay. That is completely eliminated. You cannot do that anymore if this goes through effective December 31st of 2021. The Roth conversion is still alive if you have income single or married filing separate under $400,000. You got the Roth IRA. You can still do the conversions. Okay, married filing joint over $450,000, you can't do it anymore. And if you're head of household $425,000, you can't do it anymore. And Roth conversions are basically you have traditional dollars that you were given a deduction on, and you basically are converting that to Roth and paying the taxes now so you can grow it. So if your income's below those thresholds, you can still do the Roth conversion, you just can't do the backdoor Roth, okay? And that Roth conversion rule doesn't go into effect until years beginning after 2031. So you have like a 10-year bandwidth to get through that. So you have like a 10-year bandwidth to get through that one, okay? But that's it, people. So that's the end of today's video. Thanks for tuning in. I hope you guys subscribe, like, all that good stuff. This has been another wonderful YouTube video of Ignatius L. Jackson, CPA. A lot of great topics, a lot of great information about these two new bills. And hopefully everybody enjoyed. Like, subscribe, all that good stuff. We're going to be back with you with some more info. And we'll update you on this bill if it goes through and actually gets passed with the actual final information. But for now, stay tuned. Talk to you later. Hope everybody has a good one. Bye.